We got coffee. We were ready.
Ben screwed it up though. He did not get me
I
cream
didn't screw
in my
anything up. I
coffee.
didn't make the coffee. All I did was buy the
find
coffee.
some random, what was it, almond coconut creamer.
Oh, you know, he's
inside
bougie.
Of the,
he likes the almond milk.
Well, someone on the team had that, so I just borrowed someone else's creamery.
Heck yeah, man. Well, we're back.
Money Mondays, every Monday, 3:30 Central. What are we talking about today, Ben?
What are we talking about? We're talking about multifamily financing, all right? So this is the loan that you're putting on the property and how important it is. You know, it's just, people get caught up, I think, a lot in how do you raise the money.
Yep.
But I would say, you know, as we've done more and more deals, the debt side is just as important as that.
And unfortunately, we have like a PhD in the financing side because we've hit every issue almost that you can imagine.
Yeah, but luckily we got a good partner, Mr. Anton Matley with Peak Financing. He keeps us out of trouble, consults us throughout the way, and really helps us kind of get the deal that we need, right? Because it's important, folks. It's really important. You have to understand this. All right, so we're going to hop right in. So you're applying for a multifamily loan. What's important, man?
Everything.
Everything?
No, I mean, what's important, right? So let's decipher this from what's important versus what the paperwork requirements are.
Okay.
To me, the most important thing, performance of the property.
During the closing.
During the closing.
Yes,
that
I
will
would agree.
easily kill your deal. Everything else you can find solutions for. Performance of the property, you really can't do anything besides wait another month and hope the guy gets their deal together.
Let's talk about protections, right? You know, there's certain things that you might be able to build into the PSA. It's a hot market. It's a seller's market right now. You're probably not going to be able to bake too much in there, but you do have to realize that if he or she lets their foot off the pedal and performance starts lagging, that will adversely affect your loan, right? Not only the loan proceeds, but you know it could affect how much IO you get and have other detrimental problems that go along with this, right? Yeah. So you have to really be cognizant of that and be aware that most of the times when people get under contract, right, the staff is going to be de-incentivized. They're going to be afraid they're going to lose their job. Maybe they're already looking for another job. Maybe they didn't really like the job in the first place, and this is their excuse to bail, right? Bad things happen when people realize that the property is getting sold.
And then worse things happen whenever performance drops and you're trying to close a deal.
Yes. Ask us how we know, right? You know, this has happened on more than one occasion.
And if you're buying a deal, that means what? That means you really track the performance as you're going through it and really light a fire under the cellar.
Yeah.
Right? You can't just sit back and let them kind of do their thing.
Because they will. I mean, they're really, unless there's some kind of hook in them or some kind of, financial incentive for them to keep it up, they're going to say, well, the loan's on you. Who cares, right? That's legally, is that all right? Yes, probably. Morally, that's kind of a scumbag thing to do. But most people, for one way or the other, they just let their foot off the gas. Yeah. So you have to keep up performance, and that's even on the sales side too. Do the right thing. Keep your folks in place. Keep that performance going. Keep occupancy up, because especially when you're trying to put Fannie or Freddie debt, what's the most important thing, right? 90 for 90.
Yeah, well, that's not even the most important thing. That's
it's one of the most
requirement. Is what I like to call
that's
it.
One of the most important things, right?
NOI is really what they're looking at, cash flow, right? The really DSCR is they want 90 for 90, and then it needs to be a certain DSCR. So if it doesn't have 90 for 90, you're pretty much out. And then you need a DSCR as an adjustable lever, but they're going to basically kill your proceeds until you get to that DSCR. So
yeah. All right, so 90 for 90, folks. That's 90% occupancy for at least 90 days prior to trying to close the deal out, right? So you have to realize that. So some other things to kind of take into consideration, right? The loan to value, right? You're not gonna, especially these days, you're probably not gonna get above 75%. In some cases, maybe you get to 80.
Yeah, rare cases.
But it's no longer the case because prices have just gone up through the roof. And Fannie and Freddie understand that, right?
So loan to value, right? Just so people that don't know, it means if you're buying a $10 million deal, right? You're paying $10 million for it, they'll give you 75% of that as a loan.
Yes.
So a $7.5 million loan is your max loan amount.
And sometimes, that's Fannie and Freddie. Sometimes if you have a bridge loan, they might wrap in some rehab, they might wrap in some closing costs. So maybe you can get to, and instead of loan to value, it's loan to cost, right? And maybe from 75, maybe even to 80. So there's some incentives to do bridge because they don't calculate necessarily on DSCR. It's calculated on what is the asset going to look like in 3 to 5 years when you go to sell, right? Can you exit the bridge loan, right? So they have exit tests and some other ways that they size these things up. But bottom line, you can usually get more leverage, right? So that's something to kind of take into consideration. So we talked about DSCR, right? What is it?
Debt service coverage ratio. So it means basically based on your income, right? How much do you have to cover debt service, right? So that's basically, what it boils down to. Usually they're looking for about a 1.25x, right? 1 means you're breaking even,
Yep.
right? So you're making no positive cash flow. You're making enough to cover the note. You're at a 1. 0.25x means they have about 25% left over just for kind of whatever you want, distributions or other things. So
Yep.
they're looking for a 1.25x. You don't want to be below 1 or else you're coming out of pocket.
Well, that or you're in a bridge situation, right? Yeah. And in that case, once again, you probably should have had some additional reserves.
And you're still coming out of pocket, right?
Yeah,
like bridge will let you go down to 1.1, right?
Well, we've seen them we've seen it sub 1, right?
Yeah, and they're looking for stabilized.
But they're going to want to see, once again, in 3 to 5 years, what does that deal look like? So, get familiar with that term because your lender, your mortgage broker, Fannie, they're all talking about DSCR, right? So we talked about credit worthiness.
Before we go to credit worthiness, the other important one we don't have is interest only, right?
Huh?
Interest only is just as important, right? And a lot of times these are levers. You can say, look, I'll go with the 1.35x DSCR because I want 5 years interest only, right?
Yeah.
They are looking at risk. So interest only becomes a non-interest only at some point. And so they're looking at, okay, if I give you a higher DSCR, which means less loan proceeds, which means actually a safer bet for the lender, then they're willing to give you more interest only, right? Yeah. You're trying to find that balance because some people want more interest only, some people don't, some people want higher proceeds, some people want less. So
you can also talk about interest rates,
it's basically it's a curve, and you're finding kind of where you land relative to what you want on the parameters.
Yeah, and it all correlates, and also correlates with your interest rate as well, right? You have to play with all of these things. Or try to play with these things to try to get the best deal that you can, right? And if you don't really feel very familiar with that type of stuff or these terms or what we're talking about or how all this stuff works, you need to get a mortgage broker because the lender, I'm telling you folks, they're good guys. We're friends with a lot of them, but at the end of the day, the lender is on one side of the transaction, you're on the other, right? They want to lend you money, but at the end of the day, they're not going to do it at the detriment of their balance sheet, right? So they're only going to lend you what they think that you should have, right? Versus what you think that you should have, right? So you need to understand that. Interest rate, IO, leverage, all of these things play into each other, right? So, I'll come back to creditworthiness, right? So we talked about NOI, which is net operating income. How much is the property valued at on an appraisal? That's the other part that we're talking about. The appraisal, the PCA, property condition assessment, those are very two important, components of the closing process too. So let me give you an example, right? Everything could be looking great, but you come back and your appraisal is less than what you're paying for the property.
Yep.
You're gonna have some problems, right? Because ultimately the appraiser is gonna have more say-so than, what you think the property is worth, right? And he's basing that on comps and what the cap rate is in the area and ultimately what he thinks.
A little bit of thump to the wind as well, right? There's some things you can't, you don't know where it's going to go.
Yeah.
So it's ultimately dependent on that person and what they're looking for.
There's a lot of hope and prayer that goes into, before you get the appraisal, but most of the time they want to get the deal done too. So it's usually going to be at or maybe even above, where you actually bought the property at. But if it was below or maybe it's right at, that's usually going to indicate that maybe things are going to be a little bit tight, and the lender will look at that type of stuff. The other thing that you'll have to take into consideration, like I said earlier, is the PCA, Property Condition Assessment. So that's like an engineering report, and if they come back and they say they've got aluminum wiring, they got stab lock, the roof is caving in, all of these things, right? They're going to say, ooh, okay, the property's not in great shape. No. So guess what? We're going to make you force escrow the required repairs for that. And now before, we give you any of the loan proceeds, we're gonna take $500K off of the table, right? And make you go do the work. Then I will give you the money to reimburse you, right? So sometimes that can throw people a loop.
Yeah.
Right? It can actually turn into a big chaotic process. And so you need to realize, once again, what you're getting yourself into before you send one of these engineering companies out, because by that point, the appraisal, PCA comes back, you're out $15K.
Honestly, before you really commit, you got to have already an idea of, before we do a deal, we know where the appraiser is going to come back at roughly, right? It's not going to kill us. Like, yes, it might hurt sometimes, right? If it's too low or, luckily, I think we've never had it too low. So that's good. We've been buying right. No. But, it happens. And so, but you shouldn't just be surprised, right? Even the PCA, usually most of the stuff you already kind of have an idea about, and hopefully you've already been budgeting it, right? There's wood rot, it's this. There's a roof caving in, right? That should not come as a surprise, people. And so, something to kind of keep in mind. And, you're really you're trying to just figure out just how much of it you have to do.
Yeah.
Usually there's some things that we need to do, and you figure out, okay, what is the lender going to require? Do I have those reserves? I need to plan for those reserves and kind of work through that.
Yeah, you need to have some contingency, right? I think that's important to just understand going in, that they may pop you on something. And if you don't have that set aside or have that buffer, it could be a problem, right? So, all right, so the down payment, right, that goes back to, the leverage that you're gonna have and how much money could you potentially raise, right? You need to have an understanding of how all this works, right? Because you don't wanna get caught short when you get that settlement statement and you're like, oh, I'm $300,000, less than I need, right? That could be a big problem. Because most of the time at that point, the buyer's probably not gonna have very much patience with you.
And you're not gonna have very much time.
No, you're gonna have almost zero time, right?
Yeah.
And the other thing that I wanted to also talk about too, right, is some things that you need to understand in terms of fees along the way, right? To get the application process started, it's gonna cost you at least 10 to all the way upwards. We've seen it as high as 50K.
Oh yeah.
On bridge loans, on bridge loans, it could be even higher than that. So that's before they'll even look at your file. So you need to have that. That's the application fee, right? Within that application fee, you're usually gonna be charged for the appraisal, for the PCA. So that's part of that, right? Most of the time, it's not some separate thing. It's just one big lump sum, right? And they're gonna say, oh, they'll credit it back to you at closing if there's anything left. Most of the time, especially on bridge loans, there's nothing left.
Yeah.
In fact, sometimes there might be even more charges, right? Because their lawyers are just racking up billable hours.
Yeah.
So that
guys make a fortune not doing much.
They make a ton of money. So that's the application fee, right? There's also something that's called rate lock, right? And this is anywhere from, say 3 to 7 days before you're supposed to close. You have to usually put up 1 to 2% of the loan amount as a deposit that they call it, which is called a rate lock fee, right? And that's essentially like where the lender's saying, okay, you're gonna close this thing. You got some real serious skin in the game now. This thing is not gonna blow up, right? And so you need to be prepared to put that money up. Right, because you can say 1% or 2% of $20 million deal, it's not chump change. No. So you need to understand that, and then from there, you're moving to closing, right? So let's talk about the team, because I think that's, behind the deal, the most important thing that the lender's looking at is who is actually buying this thing, right? And I think that people underestimate, I've got money in the bank. Well, have you ever done a deal like this before? Have you ever owned a company before? If the answer to that question is no, don't sit there and think that it's just going to be a slam dunk for you to get things across the finish line. You need to have that Fannie and Freddie card. Is not some real card that people get and I have in my wallet.
Whoa.
Wait, you have one?
You never got one of those?
No, I never got one, man. I'm sorry. But my point is that it's important because they really do look and see if you've actually done one of these deals before. Right, and then how well are those deals doing?
How well are those deals doing? Are they similar vintages or not? Right, They might come back and say, "Look, you've only done these C value adds. What right do you have buying this A+ asset, right?"
Yeah.
Something to think
about. Do you know
about.
what you're doing, right?
Do you know what you're doing?
They're ultimately looking to de-risk the deal, right? So they're trying to find somebody that has not only enough net worth and liquidity, which we'll get into here in a second, but also just the acumen to actually pull something like that off, right? And so like Ferris said, a Class C value add deal is a lot different than an A++, core asset, right? It's just going to be run differently. It's a different play. Right, and so you need to understand that the lender is looking very, very closely at that on top of the performance of the asset, right? So what's the net worth and the liquidity that you're going to have to look at?
I mean, basically, they're trying to see does the combined group have a net worth equal to the loan amount? They're not just going to give you a $30 million loan if you're only worth $1 million, right?
Yep.
They want to make sure that again, you are savvy enough to handle that kind of loan. Honestly.
So what's it typically though?
What do you mean?
Like the net worth, like what's the requirements for somebody?
So I mean, they're looking for basically everyone is combined of the GP, the net worth of the loan amount, right?
Okay, so it's $30 million. If you got a $30 million loan, what he's trying to say is you got say
everybody.
3.
So Ben maybe is worth 5, and I'm 5, and then we bring in a guy that's worth 20.
Yep. There you go.
$30 million, right?
Typically they want to see a little bit more. They don't want you coming right in the cusp.
You don't want to come in at 101%. You want to come in like 105.
A little bit more.
And it's a little bit loose, right? It's you're really qualifying.
I think
PFS.
They'll back off, I think, a little bit based on how experienced the sponsorship team is too, right? Once again, they're going to put more on that in the front end of the process. Maybe your first or second deal. right? But if it's your 20th deal and you've proven yourself and you have a good track record, once again, just like an investor would look at a good track record and say, hey, this is a less risky deal, the lender is doing the same thing, right? So they're going to probably not, be as hard, about that rule, right? But then liquidity too.
And liquidity is the other piece, right? So looking for the G. So again, back to the thing, if you're doing a $30 million loan, right, they're looking for about 20% of that liquid, right? And so they're looking for $600,000, $600,000 liquid.
Yeah.
It's not much. Actually, no, I did that math wrong.
No, you did.
$6 million.
I was about to say, that doesn't sound right. We're
anyways,
close, just off by 1 0.
$5 million-ish, looking for a few $1 million liquid, right?
But no, and it can't be wrapped up in your IRA or your 401k. Like that is like in a brokerage account or in your banking account, right? They want it to be liquid funds, and they take that into consideration.
Yeah, and
how do they determine all this? It's from your personal financial
everybody's
statements.
given a PFS. It has the breakdown of what you're saying the net worth is and what your liquidity is. They grab them all, they add them up, make sure, okay, is the combined amount equal to the loan amount? Is 20%? Again, 20% is different, varies from lender to lender. It's usually in the 10 to 30% is what I'll say. Bridge is a little its own thing, right? But they're looking at, okay, does that combined equal to, the liquidity requirements?
Yeah.
So going back to the example earlier, right? $30 million loan, they want to see everybody adds up to that. Liquidity, they want to make sure everybody adds up to 20% of that, and you're good to go.
All right, so.
Pause right there.
Boom,
Money
boom,
Mondays, we
boom.
do this every Monday, 3:30 Central, right? We are talking about multifamily financing today, right? One of the most fun topics. If you have comments, questions, let us know, right? We'll spend about the first 15, 20 minutes presenting, then answer questions. We will answer them here live, right? So first, Jefferson says hello. Or what's up, Ferris and Ben? What's up?
Hey, buddy.
Chat says hello.
Hey, chat.
Jefferson asks, how are the electric utilities there in Texas? Heard it increased during the snowstorm. How's the electric charge for apartments if it was also impacted?
So you have to realize that there's deregulated markets here in Texas and there's regulated markets, right? Deregulated would be like Houston. There's also regulated markets like in San Antonio, right? Or in Beaumont, which is where we have some assets as well, right? Deregulated means you can go shop your electricity rates with 20 different companies. I mean, there's literally probably even more than that. Whereas a regulated market is usually going to have one energy provider and it's going to be a set rate and there's really not any negotiation. So, just because ERCOT is on its own little island in terms of the energy grid, there's still some deregulated and regulated markets throughout Texas, and you just need to know what you're getting yourself into. But I haven't really seen a spike. I think that there was one company that kind of jerked some people around right before.
Well, no, so it depends on your thing, right? Some people have fixed rates, some people have a really floater, right? Variable. Yeah. And so if you're variable, I mean, is it the company's fault?
No, it wasn't. I mean, I'm not trying to blame them.
They lost their license because
they got screwed a little bit. But at the end of the day, we haven't seen a jack up in rates here because of that, and I don't think that we will. I think that it's going to be a hard lesson for a lot of people to learn. But hopefully it's going to be better.
Yeah, but to answer your question, Jefferson, whenever the utilities are working, it's great. Apparently they're not always working.
Yes, we'll take that.
That's just how we know. And yeah, I mean, I haven't really seen the electricity bills come in yet for the apartments, and I actually don't know if they're all fixed or if there's some caveats. So my house did not increase. I didn't get that bill yesterday, and I checked it, and so I didn't see.
I didn't see the water. My water didn't go up either, which I was happy to see.
How much is your water bill usually?
Mine's usually like $50.
Yeah, water's pretty cheap. 20,
it's not too bad,
$20. All right, let's see, keep going. So Savion says, yo.
What's up, Savion?
Chat says, Behind the Great Deal is an awesome team.
Yep.
Awesome skill
That's
team.
True.
Could you please give a breakdown of the net worth, the requirements of the GP? Hopefully we answer that for you, chat, already, but if not, let us know and we can go through it again. Yeah. And Ronnie says, what's up, gents?
Mr. Ronnie, what's going on, buddy? We're talking multifamily financing, which is, once again, we're saying that this is just as important as raising equity, folks. You need to understand how this works, and you need to have a good mortgage broker on your side. Check out Anton Matley at Peak Financing, if you would, peakfinancing.com. So, the best debt options for multifamily properties. Oof, that's a tough question, man. We just have so many good debt options. No, but I mean, ultimately, really, all joking aside, multifamily probably has the best debt of any commercial asset class, right? I'd probably say.
I agree.
We've got typically the best leverage, which means you're going to get the most loans proceeds. You're going to typically have the best spreads or interest rates. You're going to have interest only. You're going to have 30 years amortization, right? And you're going to have non-recourse debt in a lot of cases. So what is non-recourse debt? Let's talk about that because we didn't really talk about this. Well, people always like, why do they want to know about your net worth and your liquidity if it's non-recourse, right? Well, at the end of the day, they're wanting to understand two things, right? If you commit fraud, right, or you do something stupid, that non-recourse debt is now going to turn into recourse debt, and you could be on the hook for something, right?
Yep.
So they want to make sure that you still have that net worth and the liquidity. They also want to understand that people have some money in their pockets in case things go bad, right? Because they don't want your first knee-jerk reaction to go back to the lender and say, I can't make my mortgage payment. They want you to float the check to make the mortgage payment if the property can't perform, right? So that is ultimately why they're looking for those things, regardless if it's recourse or not, right? But in a lot of commercial asset classes, it's recourse. You're getting a bank loan, you're getting 25 years amortization. Your loan terms are probably 5 to 7 years.
We've looked at new construction and all that. I mean, that's the difference. Usually it's recourse.
Yeah.
Something we got to get behind. So.
Yeah, it's different than
Cash is
what
king.
we're used to, you know. So you have to realize that is the reason why they're asking that. But bottom line, you've got a lot of great debt options, right? The big players in the market, everybody's heard Fannie and Freddie, right? Which are, you know, kind of pseudo government entities. And then you have lenders that will lend on their behalf, right? You know, you're going to have the CBREs or the Lumens or the Arbors, you know, Walker and Dunlop, you know, is another one. Greystone is another one, right? Those are probably the big ones. Go check those guys out, right? You know, those are typically the people that are going to be lending the most on multifamily throughout the country, right? So, you know, and they've got a lot of different options, right? Whether it be a fixed rate or a floater rate or, you know, this much leverage or that much leverage, you know, there's a ton of different things. And some of that is dictated by Fannie and Freddie. And some of that is just a product that specific lender has. Yep. Right? You know, he talked about, you know, construction too, multifamily construction. If you can get a HUD loan, that actually might be the best debt option that you can get across the board, right? You know, that's 40 years amortization, 40-year term. Usually the interest rate is 50 basis points lower than anything you're going to see in the market, right? Non-recourse, the whole entire thing. And that's from HUD, and that is for you to construct multifamily. It doesn't have to be Section 8, doesn't have to be any of that crap. Right? It just means that you're going to get qualified for a HUD construction loan. So we talked about this a little bit earlier, right? Going directly to a lender versus going through a commercial mortgage broker, right? Now, all we can say is what we do. We go through a mortgage broker. I'm going to tell you why, right? The mortgage broker is there to position not only the deal, but the group, the sponsorship group, in the best possible light, right? In order to get you the best loan proceeds, get the best interest rate, get the best IO, and ultimately get the deal closed, right? They are there to shepherd the deal throughout the process, right? And take that burden off of your shoulders, right? Because as a sponsorship group, you've got a ton of other things that you got to think about, right? You're raising equity, you're doing this, you're doing that. There's 1,000 things you have to sign. There's all kinds of crazy stuff that's happening, right? The last thing that you want to do is be having to wrestle with the lender every single day, right? And in some cases, they can put your deal in jeopardy too, right? Where they didn't position it correctly to their credit committee internally. And ask me how I know this. And 5 days before you close, you know, your deal fundamentally changes, right? You know, where loan proceeds are now less, that 3 years IO that you were banking on is now 1, and they've cut your rehab, you know, down. So that actually happened to me. And I swore up and down that I was never going to go that route before, and I've been infinitely more happy since then, right? Because Anton's there to underpromise and overdeliver, and it's been like that every single time.
So let's see. So we'll go through a few more comments, right? Everything is deregulated in Houston, no zoning. This is true. Jefferson says thanks.
Makes sense, yeah.
Anton's Ronnie says, where's Anton? I think he's in Dallas.
He is in Dallas, isn't he? In DFW? He lives in Frisco.
I'm kidding. I meant he's not on the show. Ronnie says debt options depends on the strategy. On new acquisitions, I am looking for debt terms that minimize the prepayment penalty.
That's
Freddie
good.
Floater and Bridge seem like the best option right now.
They both have pluses and minuses, but you brought up a good point that I want to bring this up, right? We didn't talk about prepayment penalties, right? And what is that, right? So essentially these are bundled up and they're sold as bonds, right? So the bond's going to have an interest paid on it, which is the interest rate, right? And say it's a 10-year term. You know, you go to sell in year 3, right? Well, that bondholder that bought that bond has 7 years worth of interest payments that are still due, right? So depending on if it's yield maintenance or it's defeasance, and I don't even want to get into what the heck these things are, you need to look them up, right? There's going to be a certain amount of interest that's going to be considered a prepayment penalty that you're going to have to pay that loan off. So it's not just the principal amount that you have to pay, it's now those interest payments that were for the next 7 years. And sometimes that can be substantial. Think 10, 20, 30% in some cases of the loan amount.
Yeah.
It's a lot of money to think about.
Yep.
So prepayment penalty is important, and that you
We've
should
made that
roll
mistake
that in.
too. We've made them all. We have made them all.
Luckily, we've been able to learn from every mistake, though.
Let's keep going. So Ron says, can't tell y'all are wearing plaid today or not. We are. I am.
I'm not wearing
this
plaid.
Is kind of plaid. I think this is
striped. I'm looking at it on the screen. It's kind of washed out. It's got the blue pinstripes.
Between bends, yeah. Forehead, shirt, and background. It's all just kind of wash it out there. Let's see. So both go to Starbucks, so that's a good sign. Absolutely, even though Ben screwed up my order. Chat says no plaid for the guys today.
I can't do anything right today.
No,
man.
you can't. All right, let's keep going then. What's
All right.
next?
So
wait, Mondays do this every Monday, 3:30 Central. We go about 15, 20-minute presentation. If you have ideas for future topics, let us know. We will present those, right? Otherwise,
we love some other topics, please.
Yeah, leave comments,
Help us.
questions. We will go through them. But let's keep going then.
We're doing some open Q&A. Does anybody got any questions?
More open Q&A? Yeah, we've gotten a lot so far, but.
All right, so then let's talk about our toolkit, right? This is where we got all of our stuff, all of our checklists, all the webinars that we're on, all the podcasts that we're on. Everything is condensed into one toolkit, right? So go check it out, disruptequity.com/toolkit. We got it all there. We ain't selling you anything. It's all there in one happy format. So, check that out. So, what are we talking about next week, man?
Talking about how to build your multifamily rehab budget.
Which is something that the lender will ask you about too, right? That's part of the process. They want to know, what are you going to do to the property to improve it, right? And they're going to see, are you really going to be able to increase value? So make sure that you understand that too. And we've got some good recommendations on some good general contractors and rehab guys. So we'll drop those for people that are interested. But check that out next week. So what do we got? Anybody in the meantime?
Any more comments, questions? Anybody else? Let us know.
All right.
Otherwise, we did get one. Do you guys educate property investors about accelerated depreciation? Yeah. I mean, we do. We talk about it loosely, right? I mean, it's basically, for those of you that don't know, right, a big part of real estate investing is getting depreciation.
Yep.
Which means, reducing your tax burden, right, by having losses.
Yeah.
For those of you that know how to use that. So accelerated depreciation is a tool that we use to basically get more depreciation up front, right? You make it front heavy. I don't want to go into the details of it, but we have some investors that invest only for doing accelerated depreciation and cost segregation, right? And so it's a way to front load losses. I mean, I've said this story many times, and we had a friend that said we turned into white collar criminals because he didn't understand how he invested $100,000. He got a $70,000 loss that first year, and we did a distribution, right? You can you can get significant losses with accelerated depreciation and cost segregation. So it's very powerful.
Yeah, depending on your status, right? Are you an active versus passive investor? And are you considered a real estate professional or not? Like it can significantly offset some of the income that you get too. So we encourage anybody to go talk to your CPA about that. That's why we don't talk about it too much, because everybody's situation is different, right? And we are not CPAs. So, but it is a powerful tool and one of the big reasons why we love commercial real estate. So, all right, man.
Perfect.
We blew through that.
Anyone else have any more comments, questions? Going once.
Oh,
do you have a designated cost segregation study partner we use, Madison Specs?
Madison Specs. Yep. Brian Bingham, Yona Weiss, good guy. They're all on the same team. You could probably find them on Facebook, actually.
Absolutely.
So, those are the guys that do it. And every single deal, we're usually going to do a cost segregation study.
Yeah.
So.
Cool.
All right, man. So we'll be talking rehab budgets next week.
Next week we'll talk the rehab budget. Otherwise we'll call it a wrap right on time. So going once, going twice, and let's call it a wrap. Thank you all very much. Monday Mondays, 3:30 Central. We'll see you next